You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
So we use policies all the time to help clients get out of debt, again, if that's their priority. If they have a credit card debt or loans or school loans or whatever it is, we can build up the cash value inside of a whole life policy and then turn around and pay off that debt. So what we'll often do once that credit card debt is paid off, we will just redirect that payment that you were already used to making from your credit card to your life insurance policy. So your outgoing cash flow can remain the same. Now, that's one of the ways that you can start repaying your policy after you have paid off a debt or a credit card debt. And so as an example, if we had, say, a $10,000 amount on a credit card and we're building up a life insurance cash value, and at some point we have $6,000 in there and we want to use that $6,000 to pay down the $10,000 balance on the credit card. So we go ahead and do that. And now you owe $4,000 on your credit card. What we would want to do is take the difference. So your credit card payment is going to go down when you've paid off that large chunk. And so you can take that payment that it lowered by and move that amount, the difference between what you were used to paying when the loan was at $10,000 or the credit card debt was at $10,000. And now what the debt is at $4,000, your payment will go down. And so you can take the difference and start redirecting that back to your life insurance policy to replenish the funds that you took out to pay off the credit card debt. So that's one of the ways. There are many ways that we can go about doing this. This is kind of just to help you see it in your mind and get an understanding of how that might work. When the amount you have in your policy is not quite enough to pay off the full debt that you want to pay off, you can just pay it off in chunks as you go. And if it's a credit card payment, something like that, your payments to the company will reduce as you're paying off that debt. And so you can redirect those funds. And sometimes, or most times, a lot of people are paying more than that credit card payment to the company because they want to pay it off, right? You don't want to pay so much interest. You got to get this thing paid off. So a lot of people are doing their best to pay over and above what the minimum payment is on their credit card. So sometimes when people have a really tight budget and they don't see a way for even beginning a whole life policy, sometimes it's possible to even reduce those credit card payments down to their minimums, free up that extra cash that you were sending to the credit card company to help you fund a new whole life policy, and then start building that up. And then we're going to turn around and pay off that debt in the future anyway. And so now you're going to be able to lock in the earning power of those dollars that you were sending away to the credit card company. And you're going to be able to lock those in and then still turn around and pay off that debt. So it'll be paid off a little more slowly. It's not going to be as fast as if you were sending that money indirectly, but it's going to retain the earning power of the dollars before you send them to the credit card company. And so it's going to be better for you in the long run. If it's loans or mortgages that you want to pay off and it's not going to work the same as a credit card, meaning as your whole life funds are building up, you're not able to pay down a bit on your mortgage or on a loan or say a car loan, it's not going to bring your loan payment down. It's going to stay the same. You know, like if you have a car payment and you throw a big chunk down on that car principal that you owe, it's not going to bring your car payment down. You're still going to have the same car payment. So sometimes it's best, or people prefer, to wait until their whole life cash value gets large enough and then they can pay off the whole debt at once. Then in the meantime, they have the comfort of that cash building up like an emergency fund, or in case some other need or opportunity arises and they want to be able to take advantage of that. They're not throwing it into that loan payment and still feeling the tightness of the paying that loan at the same rate that they already were. Some clients have a goal to pay off their mortgages, the homes where they live. And I really think this is per person and per client, what their goals are, what their overall financial picture is, if they're going to be living there the rest of their lives, or they're keeping it, or they're going to rent it. In different scenarios, I say, it could be good for that person if that's their goal and they want to achieve it, and that will make them feel good and confident about their financial future. I wouldn't always just say a blanket statement that you should pay off your home just because, yes, you're paying it off and you're going to have the equity there, once you pay it off, but you also don't know the direction the market's going to go. So over time, in general, yes, it's been going up, but you never know at the time that you might need that equity if it's going to be a down market and now you've just lost the money you just paid into it. So you pay down your house and then the market goes down and there goes a couple $100,000 that you could have used somewhere else. In addition, your equity isn't really earning you money. Your house is going to appreciate one way or the other, whether or not you have a large equity in there. But also creating that equity is just creating the opportunity to take a loan out with a bank if you need it. And then you have all the rules of having a loan with a bank and the restrictions, and you're going to have to pay it back, and you have to pay it back every month. And so you have more restrictions there. Whereas if you're building the equity inside of your asset of whole life insurance, you have full and complete control over that. It's going to be a lot better for you. You're going to have access to it. It's going to be growing for you on a guaranteed basis. And so I think that that's really where you'd want to build your equity as opposed to putting it all into the house. Of course, again, that is per person and up to what makes sense for that person and their family. Now, let me just paint a perfect picture of what it would look like to be in control of your debt. And as it happens, this is exactly how a life insurance loan works and what it's like to have your loans inside of life insurance. To be in control of your debt would allow you to, first and foremost, be able to control your payment, right? And what does that mean? Well, you'd be able to choose interest only. I want to pay interest only on my loan and for as long as I want, for the life of my loan until I pass away. That is an option if you have a loan with a life insurance company. If you want to pay it back all at once, you absolutely can. You can pay it back all at once with no penalty. You also could create an amortization schedule where you're paying principal and interest, or you're creating something where you have a plan, and you can choose those variables. We build these for clients all the time. We create plans for them so that they can have it more where they can see it and know exactly how much they're going to pay and for how long. It's just more spelled out for them. So we do that all the time for people. And then you get to call, like, what interest rate am I going to charge myself? How long am I going to pay this loan back? Or what payment do I want to make per month, and how much interest do I want to pay myself back? And then the software will tell us how long you have to make that payment. And so you get to choose those variables. You also have the choice of paying it back never. So you can choose just to never pay that loan back. Now, that's not always the best situation, especially in your younger years when you're building and you want to use this again for retirement. The best choice, of course, and that Nelson Nash would say, is always to pay yourself back with interest and a higher interest rate than the insurance company is charging you. So you want to pay yourself back with interest. That's going to replenish the funds back to the account. And then you're able to use them again. You're recycling your own money, use them again all throughout your life while you are going through life needing different things, mortgages, or you want to invest in real estate, or maybe you want to purchase your car through there or help your kids through college. You can keep it going and keep recycling that money. And then once you reach retirement, so long as you've been paying yourself back with interest, you'll have that money there again and you can use it for that. And then we have some different ways of pulling those funds out where we don't expect you to have to pay back these massive loans. One thing you don't want to do is to accumulate massive loans while you're in your younger years and then you're having a hard time paying them back. Or if you're paying nothing back and you're just only accumulating loans, that will be not a good idea. It will be hard to kind of replenish it. You're going to feel like you're always behind. So it's not a good idea just to only fund the policies and only pull funds out of it. You're going to want to have something going back, paying it back. But it is great to have the option and the opportunity to do what you need to in the time period you need to. So if you're paying back a loan, you have, let's just say you paid off a bunch of credit card debts and your car payment and a boat payment or something, and you're replenishing all those payments back to your policy at, say, $1,000 to $2,000 a month, and you're repaying your policy loans at that rate, but then something happens. maybe there's a disability or sickness or something, and you can't work for a period of time. So your income is much lower. Of course, I would hope you would have disability insurance, which I could help you with if you need that, but you don't have as much income as you have used to coming in. So you would have the option of stopping that loan repayment for that time period. Maybe you're unable to work for 1 to 2 years or 3 years. Well, you can just pay nothing back to your loan repayment to the company for that amount of time while you're getting back on your feet or getting well. And so no other place has that option where you can borrow money out or use that money and then pay nothing back for a period of time or until you are able to pay back. Nobody has that option except for a life insurance company loan. And so being in that kind of control just puts your mind at ease for things that could happen, tragedies or whatever just can happen. Obviously, life happens. And so it's nice to be able to have that flexibility. Another win with life insurance loans is that when you do make a payment to the policy, that payment goes 100% to principal. So your loan is being paid off as fast as it possibly could, unlike every other loan. Normally, when you send in a payment, whether it's to your mortgage or a credit card, they break away some of that money that goes towards interest because they need their money. They've been lending you money and they want to get paid. And especially when it's a mortgage, and especially in those first 5 to 10 years, when you're making that mortgage payment and say your mortgage payment is $2,000 and $1,800 of it goes to interest. And so with a life insurance loan, if you're making a payment back to the company, that payment goes 100% to principal. And at the same time that you're replenishing that money, you have that money available again to use. So it goes into your pool, it pays down the loan, and now it becomes available for your use. Now, there is more detail around that. Obviously, I'd be happy to clear that up, but I just wanted to make sure I pointed that out because it is an awesome feature of life insurance loans. And one thing that we do at Alpha Omega Wealth Northwest for our clients, we will build debt pay down spreadsheets. So if you have a few debts that you want to eliminate and you don't know the best way, and you're working with me and you're one of my clients or my team at Alpha Omega Wealth Northwest, if you're one of our clients and you want to pay down your debt, we will help you. We will build a spreadsheet for you. We will show you exactly how you can do it using your life insurance policy. We put all the numbers on there. We put all your debts up there, and we show you we illustrate it. So it's not 100% perfect because things can change and life is always happening, but it gives a really great illustration on how you can pay down those debts. And it can be really, really close to what's actually happening over time. So you can see how it will happen and how it will work and approximately how soon you'll have those debts paid off. So as always, if you would like to connect and receive my help in creating an infinite banking plan for you or your family, please reach out to me at Valerie@alphaomegawealth.com. I love hearing from you and I'd love to meet you and connect with you. Thank you for being here. I do appreciate you. Thank you for listening in. And I do hope you have a great week.
This is thepodcastfactory.com.